Hello and welcome back. This is David from the Personal Finance Squad. What we have here is a 12-month expense planning grid. This grid is what we've been talking about through the entire book. And if you're going chapter by chapter at this point, by the time you get into chapter 3, you're going to see where this grid is used through the entire book. We use this grid so that we can make variable expenses into fixed amounts. That way we get consistency in the budget. We get rid of those ebbs and flows or those spikes of up and down. We want consistency so our money is a known amount every month, and that lets you have better coverage and visibility in planning. So you can see that we have a loose example that has been put here. So let's just say, for example, someone is going to class, cooking class every month. So here's some numbers put in, and you can see that this grid will automatically calculate the total amount that you're going to predict through the year. And then down here it's going to input the average. And so what it says here, if we round up, is that average is $52. So really, you would put $52 here for all these months. Now the cost could be different, right? So we could say, again, this is loose, but we put this here. So now this will run your expense planning grid to see if you need any added cash. And that's the whole point. Not only do we know the fixed amount, which is really the average, we also know from doing this planning if there's going to be any added cash needed at a given point during the year. Sometimes when running this exercise, we'll see some negatives run in and out a few months of the year, and that would be a negative balance in the supplemental account, so that's why the added cash is needed to go up front. However, when you put added cash in, it will replenish itself when you start the new 12-month cycle. So looking at this grid here, you can see that by the end of the year, there's actually $2 left. And there's no point in this scenario where there is a negative balance in any of these items. So this is great. This means you do not have to have any money to put up front. Now, this to from sub column is what tells you what's coming in and out of every month. So if it's in black, it's money going to, and if it's in red, it means it's negative, so money's coming out of it. And then it will, again, calculate your current supplemental balance and then your new balance for the month after this has taken place. So these two are important right here. And then ultimately, we see that no cash is needed. So if all of these turned out this way, it would be great. Now, there are cases where that doesn't happen. So we have a sample right here where we see that's not the case. Now, you can look right here and we can see that we know that's from SUP in this case right in the first 2 months of the planning year at negative $12, and that leaves a negative balance. So in order to do that, you need to put some extra cash in there to take care of it. So in this case, you see, okay, I'm in the whole $12, so I'm going to put 12. And then in the second month of February, it happens again. Put 12, and now you can see when you do that in both of those scenarios, it makes that new balance in SUP at a zero balance, and that's what you want. You do not want to be in the negative. So now through the rest of the year, this scenario shows that there's going to be no more money. And then you can see down here that this money right here is $24. And that's what you're going to need to put up front to start this account. We've already been through the book. You'll notice as you build your budget or redevelop your budget, you're going to have upfront cash for a number of items that you're going to need. This is why you need it for every variable expense that you have, so you understand the kind of money you need to establish up front. But once you do that, you're in good shape. The only time that you would need to add more money in the future is if the bill itself went up that you're paying for. So if you paid $100 a year for license plate tabs or for the DMV, and it went up to $120, then you're going to have to make that change. But the whole point is to stay within a very small variance, up or down, so that, again, you have a fixed number and you know the money that's going to come in and out every month. Okay, so that's going to do it for this exercise. Use this tool effectively. It is one of your best tools to get your budget to be, again, consistent. And we will see you in the next budget exercise. And thanks for joining.